We're here to talk about private equity today and our new special issue on private equity. When people think about private equity these days, because of the presidential election, they think a lot about Bain. I wrote an article about the Carlyle Group and David Rubenstein, and he made the point to me that all this talk about private equity over the last year, and no one's focusing on what private equity actually is supposed to do, which is generate returns for investors, and no one actually has focused, in Bain's case, on how it does that, but you did.
You know, I basically just went through deal by deal. I mean, it's right there on their website. So if you take the time, you can look at every deal they've done in the past, going back almost 10 years, and see, well, how has it turned out? And they've had some spectacular successes, no question. I mean, as you know from the Carlyle story, they can take a company like HCA and create a huge amount of value. But they've had a lot of duds too. Clear Channel Communications, it's really hard to see how they're going to pull out on that one. The larger question is, what kind of returns are they generating for their investors? And would their investors really be better off just putting money in an index fund? And my conclusion was, at least since 2004, they probably would have been better off in an index fund. I think Bain investors would dispute that. They have their own way of calculating things that gets them a higher return. But my conclusion was no.
So forget all the vampire stuff and all the vulture capitalist stuff. These guys are in business to give returns to their investors, and you're saying they haven't done a good job of that.
Yeah, I don't think so, because they have the spectacular returns that bring the money in, but they also have very risky deals. They add more leverage to the companies they buy, so that makes them more risky than they were if they were sitting in the S&P. And they also have an unlimited call on their investors' money, and that's very valuable. I mean, if I have an agreement with you where you get to pull money from me at any time you want, I should get a lot of compensation for that, and I don't think they're generous.
These are the general questions that people have about private equity, about what kind of liquidity premium should be provided, what is the real cost of locking up that money for so much time, and is that really even reflected in the internal rates of return metric that most investors use to judge these investments?
Yeah, that's it. They're looking at it and saying, well, I don't really care, this is a small part of my portfolio. But I think they're attracted to the glamour of the business without looking more closely at their returns. A lot of these sophisticated investors would disagree. I do think it's not true in the case of Bain, certainly, that this is slash and burn capitalism. They put a lot of money into these companies. I was surprised to learn they're heavily into restaurants, retail, businesses I don't think I'd touch with a 10-foot pole. Retail in particular is very capital intensive, and I saw no sign that they're skimping on capital. And Clear Channel, despite the downturn in advertising, you'd think they would just walk away. They haven't. They've poured a lot of money into that, and their theory is that they're going to end up consolidating and gaining at everyone else's expense.
So are we going to see scary ads now, not involving laid-off factory workers, but maybe limited partners and Bain funds, thrown out by the Obama campaign?
Yeah, maybe so. He took my retirement money away.
Now, one of the things that I do like about Bain from an institutional standpoint is because of the whole Mitt Romney situation and him leaving, they are kind of a little further ahead than some of the other firms in institutionalizing the firm and having the whole generational handoff happen. And I think that is a good thing for Bain that some of these other firms like Carlyle will have to deal with in the future. Did you get a sense from them? You talk to them, it's pretty rare. They've been trying to stay under the radar during all this controversy, but what was your sense of that from them?
Well, I think they're long-serving people that I talked to. They've been there, in one case, Pagliuca was hired by Mitt Romney in 1981. So they've got a core group of 9 or 10 partners that have been there a long time. I think they managed the transition well. And they are pushing the company into a lot of other fields, kind of like Carlyle. Money management more broadly, distressed debt funds and that kind of thing. So they're building up a big franchise here, and who knows when they take it public, but they probably
Do you think they are? That's one of the big questions. A lot of the other private equity firms have gone public over the last few years. Bain seems to have resisted. Do you think they'll do that?
Well, there was a reasonably high-profile article by a competing news organization that gave an $11 billion valuation.
I think that's way too high.
I think that's way too high, too, but I don't think the firm discouraged that.
Did you get a sense, talking to them, that all the negative attention that they've received over the last few months, the President of the United States has been bashing these guys. It's probably the most vilified company in America right now. Did you get a sense that all this has affected them in any way? Do they go to Thanksgiving leaving and they're afraid to hear from their family members because of all this bad publicity?
No, when you do an interview with these guys, they're as analytical as Romney was in the 47% speech. I mean, I think they take a much higher level view of all this. They pointed out that their investor base is incredibly loyal. They've got a very high percentage of investors who have been with them since the beginning. And I don't know if this is the case with Carlyle, but 20 to 30% of the funds they raise now are coming from internal, from employees and
actually, Carlyle is very similar that way. A lot of private equity firms, the big guys, the big partners try to put as little money as possible into the fund. Bain is an example where they're putting in a lot, and Carlyle as well. I think Carlyle partners have committed $5 billion to funds and $700 million just to this one fund that they're raising right now. So I think that must make investors feel good.
Yeah, and I think they can say we can handle bad PR if the investors have been with us for 28 years are re-upping, then what do we care? And
did you get a sense whether they're bullish right now? There's a big debate within the private equity world about whether now's a good time to put capital to work.
I don't know about follow-on acquisitions. I know they're still raising money. It seems like they're raising money mostly in Asia and Europe. They are modestly bullish, I would say, about these heavily cyclical businesses they bought into. Clear Channel being the classic example. I mean, I don't think there's any way you could say Clear Channel isn't massively underwater based on what they paid, but they're saying over the 5-year period, this could turn out to be a big winner. And so I would say that's got to be reasonably bullish about the economy coming back, because as we know, advertising is, the first to go and the last to recover.
Mitt Romney is running for president partly with this argument that he understands the private sector because of his work at Bain.
Right.
Does his work at Bain and how he built this company, which is really one of the most successful private equity firms in the world, does it all give us any insight into what he would be like as president?
Yeah, I think it comes back again to the 47% speech. I watched that and I thought that's the Bain consultant, the Bain Capital guy talking. Very analytical. But there's not a lot wrong with that. I think when you're assessing whether to go into an industry like retail or restaurants or buy a specific company in it, you have to weigh a huge number of variables, and they seem to be pretty good at that.
So you're saying that he used that kind of corporate approach in that speech, and obviously that's been used to cast him in a very negative light, but you think that using that corporate mindset was what he was doing at that meeting, and also could give us some idea of how he would pursue things in the White House?
Yeah, I think so. I think if you're managing, indirectly managing however many, I mean, they've got close to 20,000 employees at Clear Channel. God knows how many employees at Blooming Brands. It's a bunch of restaurant chains. I think if you're managing that kind of workforce and those kind of flows of capital, probably you'd be able to function pretty well managing.
It's certainly a macro view of the world. You're not just running one company in one place in one industry.
Right.
You're looking at things very broadly. It seems like it might be good preparation for running a country. Did you get a sense? I mean, we talked about returns earlier. I mean, the returns were very good in the Romney years. Did you get a sense that they lost something when he left?
They got big. I think that's basically it. They were small, they got big. The Staples deal that we looked at, everybody trumpets the Staples deal. The amount of capital in play there was tiny compared to anything they've done since 2004, So I think it's easier to make big returns when you're not betting as much money.
Great. Well, Dan, thanks so much for talking to us about Bain, the most high-profile private equity firm maybe in history right now.
Yeah, thanks a lot, Adrian.